Hi everyone, it's Tarek here. This is lecture 3 in the Insider Trading course series. This lecture is going to focus on how to identify insider trades that have market, perhaps, that predict strong price moves. And the reason why this is challenging is because there are actually quite a lot of insider trades every day. If you go to the website I have mentioned a couple of times, openinsider.com, and if you go to the latest button at the top and you say just click on latest insider purchases, it'll take you to a page like this where you'll see this is June 17th. You can see all of the purchases June 17th and June 16th, and it's a long list, right? And every day there's a new list, and therefore it requires a little bit of practice to be able to identify which trades are actually meaningful or important to consider. So, for example, size matters a lot here. So, for example, there's a senior vice president, Ronald, who purchased $95 of Franklin Financial Service. This is probably, this is very much not important. And there's a couple of these here. You have someone named Gandhi who purchased $4,000, $1,000. So right away there's quite a few trades in this list that are not useful. So we can go latest, and we can say latest insider purchase is greater than 25,000. And that's a cutoff that Open Insider chose to use. So this gets rid of a lot of those small figures, but it still has quite a few. I mean, $37,000 purchase, $46,000. Maybe for someone who's important in this company, probably these numbers are not very meaningful, right? You're really looking for an insider to put a lot of skin in the game. If they don't already have a lot of skin in the game, you want them to put a lot more skin in the game, because they're only going to buy a lot of the stock if they think that it's going to go up significantly, right? So, and then you have to also say, what's the increase? You have to also look at, so size matters. You also want to look at already how much they own, right? So I was here, you can see that Eddie Lampert, who's a very famous investor, he is a big investor in Sears, which spun off Land's End a while ago. And it looks like he purchased at $15.75, he purchased $3 million of Land's End. Now that seems like a lot, but first of all, Eddie Lampert is a billionaire. So $3 million is not a terrible amount of money for him. And he already owns 18.3 million shares, and he's only buying 200,000. Right? So this is about a 1% maybe increase in his stake. So this is not, if he made a 25% increase in his stake and maybe put in $40 million, then you would think, okay, this is something very big. There's something coming up. Either the stock price has dropped significantly and is very undervalued and will correct soon, or something is on the horizon that makes Eddie want to buy so much stock so quickly. So you have to look at not only the size of the transaction, here it's $3 million, but also how many shares this person already owns, and how wealthy is this person. So how much more skin in the game are they putting? And so that's one way to look at things. Then you also want to look at the title. The CEO is the person who has all really the plans and is best familiar with the company on a day-to-day basis. He knows the people there, the culture there. He's the one actually going out and talking to the suppliers and the customers, and he's the one who's actually usually informing the board members of how the company is doing and what the options are for the future. So the CEO is oftentimes considered the best person to follow when looking at insider trading. The director is more removed. So the directors are usually quite smart people. They're usually very accomplished in that field too, of the company's area, the company's sector. But the directors are not as involved in the day-to-day operations. They're more big picture strategy. And again, a lot of that strategy comes from the CEO as the CEO tells the board, here are a couple options. What do you think is the best? The directors meet maybe once a quarter, and oftentimes, and maybe they may meet more than that if there's actually something going on. But when you see a director purchase, it's slightly less informative than if you see a CEO purchase. And also there's these owners, these 10% owners who are not also, so sometimes you'll see, so 10% owners are required to also report any transactions of the stock. These guys are not officers, they're not directors, they're oftentimes investors, like probably Chanel Capital LLC or Creek Asset Management. These are 10% owners. They may buy a big stake, but you have to remember that these are big funds. They may be a multi-billion-dollar fund, and therefore when they buy $1 million of stock, it's really not much. Here again, like they buy $1 million of stock and it's 1% increase in their share count. So you have to look at how much money these guys have under management, how much money are they putting into this position. And again, they're invested in the company. They probably have better information than a regular shareholder, but they're not going to be as informed as the CEO and the CFO. So really, those are the guys you want to follow. And then the directors are second best because they are involved, but more at a quarterly level rather than a day-to-day level. So the other metric that you would like to use is you'd like to look at clusters. So you want to look at, I think it's on their home page. Yeah, they have this section called latest cluster buys. So it's better also if you see not only one person buy, but if you see multiple people buy, right? One person can buy for a variety of reasons. Maybe they have an inheritance and they want to put it into the stock, or maybe they think that the stock is undervalued, but everyone else at the company thinks it's overvalued, right? And so individual biases can enter when only one person is making a decision. But if you see 4 or 5 people making the same decision, then probably it sends a stronger signal. Probably it's not noise. Probably there's some information in this. So if we look at these clusters, it shows you how many insiders were part of this purchasing, and you can see it's usually during a set time period, so within a week, for example. And you can see, let's just pick, so Signet Jewelers, supposedly there were 12 purchases, so let's look at SIG. So you can see here the 12 purchases. You can see the CEO purchased $250,000 of stock, a director purchased $300,000 of stock, and another director purchased $100,000 of stock. The CFO put in $100,000 of stock. CEO. So everyone is buying, and that's a pretty good sign. It looks so. Let's just check whether these are open market. So the other thing is you want these transactions to be open market purchases. The way to check that is to click. I did that kind of fast. You want to click on the filing date URL, and that'll open up this, which we've seen before, which is the actual Form 4. In the Form 4, you can go through and you can see, okay, this guy named Mark, he's the CEO of Signet Jewelers. He purchased 2,900 shares, and it doesn't explain. Usually there's a footnote that says purchased in the open market. So if it doesn't have that footnote, I would be skeptical of whether it's an open market purchase. Let's just see if anyone else has a footnote. Usually the same attorney files this for all the staff. So nope, this doesn't have a footnote either. So what suggests that this is open market purchase is the fact that everyone's purchase prices are at different levels, which suggests again that they're buying it in the open market. The situation I'm looking for, which I'll show you at some point, is that oftentimes managers will participate in an offering. So if the company offers new shares, say at $25 a share, then all of the executives may participate. It may actually be required that they participate in order to successfully complete the share offering. But they may participate, and then it'll show up like they purchased, it'll show they all purchased at $25 a share. But that's not exactly the same significance as if they purchase in the open market, because when you purchase in an offering, you're maybe doing that because the other investors who are buying your shares want the management to have more skin in the game, rather than the management thinking that the stock is undervalued. And so the incentive, the rationale for the trade is harder to piece out. So here, though, it actually, because all the share prices are non-uniform, it does look like this is open market purchases. So that's very, so the price, you can see the stock price is down recently, and therefore it sort of suggests that there's quite a lot of consensus at the company that they think the stock is undervalued. Let's go back. So let me quickly click on another one because I'm pretty sure. So this is Heritage Holdings. Here he had some purchases too. Let's just see if there's a footnote here. So here, Bruce, he's the CEO too. He made a purchase of 18,500 shares. And you can see there's usually a footnote either next to the code, the purchase code, or next to the price. And it says on the footnote, the price is the weighted average price for the transactions reported on this line. The range of prices are between $13.10 and $13.60. So those are the prices between which he bought his shares. And if you request, you can get each purchase at each separate price. So this is definitely an open market purchase. It says so in the footnote. And that's a very strong signal also. And the fact that he wasn't alone, we look, he bought twice. He bought May 11th and June 15th. But he was also joined by the CFO and by a couple of directors. So also, and this stock has been heading down for quite some time. So that's also a strong signal. So this is just for screening, right? Then once you found a couple of candidates, you're going to want to go dig deeper and figure out, well, why has the stock price been drifting down? And do I really believe that the company is undervalued? One lesson that I've learned is that while these guys purchase now, the stock is drifting down, and oftentimes the stock will just continue drifting down a lot more even after they purchase. It could go down half or more than that. And it's not that the CEO was wrong to purchase, and it's not that he didn't think that stock was undervalued, but they're not always great timers. These guys are business people. They're focused on the operations, and they're also long-term. And in the short term, the market could continue down and offer investors an even better price. So sometimes it's good just to see buying and then try to buy it at half of what they buy it at. Then you're pretty much guaranteed a good price in the long term. So that was Heritage Holdings. So we've been looking at buys. You can do the same thing looking at sells. You can look at insider sells greater than a certain price. And you can look at clusters of insider selling. So insider selling is harder to identify because insiders can sell for a variety of reasons. They might sell $100,000 to pay for their child's tuition. If they have a couple of children, they may need to sell $200,000 just to pay the tuition for the private schools, right? And if they're going to buy a house, then they might have to sell some stock. Or they might just want to diversify because they already hold so much of the stock. Or they may be retiring, or many reasons. And you don't know the individual or the person's reasons, and therefore it's harder to interpret whether they're sending a signal. But if you see a cluster of insider selling, that's very unusual, and if it's big insider selling, that definitely suggests that the stock probably is overvalued and probably going to decline, and is a signal to get out. Not always a signal to short. So insiders may be selling just to capture some gains. They may not think the price is going to go down, but they want to take some money off the table. And so if you're going to go short a company, then you really need to have a good sense of timing. And I don't think insider selling gives you a good sense of timing unless someone really unloads rapidly their holdings. Okay, to show you how predictive this can be, and this is definitely hindsight bias here, but I have a friend who actually made this trade and did very well. So Las Vegas Sands is a major casino company, and we can see, I just want to show you back in the bottom of the crisis, of the financial crisis, March 2009, you can see that the chairman of the board and CEO and 10% owner, Sheldon Adelson, and his wife, Miriam Adelson, made very, very large purchases. You should notice that they purchased, these are at the same price, the same quantity. So they are probably the same transaction. So it looks like they made together a purchase of about $37 million. Now that's doesn't seem like a lot of money. These guys are quite wealthy. You can see he has 338 million shares. So this guy he's now a billionaire. But we have to remember one thing, which is that he was, if we look at the stock chart, so let's look at the stock chart. This guy was worth, $60, say $100 times 338 million shares. I mean, this guy was worth tens of billions of dollars, right? And then the stock collapses to the dollar level. Here it's $1.77, right? So he's still worth hundreds of millions of dollars, but he's not worth tens of billions of dollars anymore. He lost a lot of money on paper. Yet he reaches into his pocket and puts in another 37 million bucks. And this is, they're wealthy, and this is maybe not so much money for them, but still, this is a substantial amount of change to put into the stock when the stock is trading at a price that suggests it's about to go bankrupt. And what happened is that soon afterwards, if you followed this guy, he reported these trades in April. Soon afterwards, by the end of the year, you're looking at a $20 stock. So you're looking at a stock that was around $3 a share going to $20 a share, or 7 times your money. And then in another year, it goes up to $50 a share, right? So you made a very, very nice return by following, and it was a very scary time period. But if you see the chairman of the board and a major shareholder buying in that moment of distress, they're probably not going to be buying if the company is really going to get wiped out. If the company is going to go bankrupt, then the shareholders are going to get wiped out. So to recap, insider trading can be very predictive of large moves in the price, as I just showed you with Las Vegas Sands. And the difficulty is that there's so many transactions reported every day, but we went through a couple of criteria that can help you choose the ones that are more informative. We said, well, maybe we want to look at purchases that are only a certain size. We want to get rid of all of the small purchases because those are probably not meaningful. And honestly, I think $25,000 is too low. I would set at least $100,000 as a minimum. The other thing we talked about is we want to look at not only how much they put in as in terms of money, but we want to look at how much money these people have. Are they billionaires, or are they just millionaires? And how much is it relative, say, to their salary? Are they putting in a whole salary or just a month's worth of salary? And then you want to look at whether they're buying by themselves or whether they're buying in clusters. Is it just one guy who may have a biased opinion, or is it a consensus that at the company everyone really thinks the company is undervalued and will be going up? And with these criteria, you can start to identify companies that may be worth digging into the future. And then you have, I mean, this is somewhat of a screening device. You don't ever want to just follow insiders right away, because I said I've done this many times, and it's very, very probable. For example, I can show you this. I've been watching Titan for a long time now. Let's look, so we can, sure. So here, the president of the company bought $200,000 at 14 bucks a share, and a very smart hedge fund man named Mark Rachesky, who also owns more than 10% of the stock, he bought $7 million worth of the stock at $14 a share. Well, you can see what happened. The stock, in a matter of months, so you can see this is July 2014. Let's just go to the chart to make sure we have the time right. So you can see here, July 2014. This is right when they're buying right here, July 2014. Within a few months, it fell to 10. And then by the end of the next year, it was down to 4. And then hit $2.50 was one of the lows down here, 270, 250. So you have major losses. But you know, if you look at what happened, the CEO he actually bought when it was 10. For some reason, that's not showing up. But he bought when it was $5.30, and a bunch of the directors also were buying when it was $4. And then right after this trade, it went down to $2. No, see, this is in November. See, he was buying here, and then it fell down to $2. But then it went up. It went up to 7, and I really think that this company has a lot of potential. Probably can go to 20 once farming recovers. And but this is an illustration again of how you don't want to follow these guys blindly, because if the stock is falling, it's very, very likely the stock is going to continue falling, and you're going to have to do your own homework to figure out whether the decline has arrested and will turn around. But this is a must-have tool in your toolbox if you're investing, and I'm happy to share more. Please comment below if you found any of this useful, if you have more questions, or if you have any topics that you'd like me to cover going forward. Thank you for your time. Bye.